There have been so many questions in the last several months because there's so much focus around the Fed on monetary policy. But there should be even some questions being looked at about fiscal policy and the types of reactions you get when there are shocks thrown into the mix. Some research looks at that component, and a pleasure to be joined by Courtney Wiegand, who is an assistant professor of finance here at the Wharton School. Courtney, great to have you with us today. Thanks very much for your time.
Thank you for having me. Happy to be here.
What was it that had you interested in looking at this component of fiscal policy rather than the monetary side?
Yeah, so after I graduated college, I worked for 2 years as a research assistant at the Federal Reserve Board. And one of the responsibilities of the section I was in was to look at the real time financial market response to various monetary policy shocks. So, how is, financial markets responding to, monetary policy statements, press releases, things like that. So, I always thought it would be really interesting to do a similar thing, but with fiscal policy, because in my mind, I'm like fiscal policy is one of the main macroeconomic policy levers in the United States, but our understanding of how it affects financial markets in real time is rather limited. And so I thought it'd be really cool to try to answer that question. And I was able to sort of leverage my understanding of how Congress formulates this policy from my time interning on the Hill. So I interned a few times at the Hill. Specifically, my time at the House Budget Committee was helpful
Right.
because that's where I learned about the budget resolution reconciliation process, and so I was able to use that process to understand how to formulate shocks essentially and then study their effects on financial markets.
Is it safe to say that where we are right now around deficits is really an area that is going to be it's focused on, but it's going to be focused on even more because of some of these dynamics at play.
Yes, exactly. So we see like there are these growing concerns about rising debts, debt to GDP ratio, rising federal deficits, and that this is kind of like a persistent and even growing concern more recently. So one thing that I find is like these effects on financial markets is persistent over time. So even going back to the 80s and 90s where deficits were much lower, there's still these significant effects of deficit news on financial markets. But I find that like bigger shocks essentially leads to bigger responses in financial markets. So now we're seeing this current climate like larger shocks. And so the extent to which larger shocks have larger effects on financial markets, I think we're seeing even more like commentary about that.
So give us an idea of a shock that you used in this research and the kind of impact that it ended up having.
Yeah, so very broadly, the way I construct these shocks is looking at these budget resolution documents. There are these outlay ceilings, so essentially how much can Congress spend for the next few fiscal years. These revenue floors, how much they're trying to collect in revenues over the next few fiscal years. So the difference between those being a deficit target. And so I use changes in these deficit targets as the budget process unfolds to identify the timing and the magnitude of deficit news. And so a recent example would be the One Big Beautiful Bill. So this was the result of the budget resolution reconciliation process. And one of the effects of the One Big Beautiful Bill was this tax cut. So this essentially like decrease in this revenue floor. So we're finding that this has significant effects on deficits, increasing them going forward.
So then with that reaction, what ends up being the impacts that you see with these types of shocks on things like the bond market or on Wall Street?
Yeah, so I find that news of higher future expected deficits leads to an increase in nominal yields. And so, looking at this response, I find that about one third of this increase is in break even inflation, and about two-thirds is in real yields. So, indeed, there is this inflationary effect of higher future deficits, but it's not the full story. And then looking at the real yield side, looking at the full like maturity spectrum, I find that there's both this increase in short term rates, which is
Right.
often used as like a proxy of monetary policy going forward, as well as when we look at long term rates, about half of the effect, the increase in yields, is in this model estimated term premium component, which is essentially measuring the extra compensation investors are demanding for holding interest rate and inflation risk.
Right.
So essentially, news of higher future deficits makes this debt riskier, and not necessarily riskier in terms of default risk, but in terms of greater uncertainty about the future path of inflation and interest rates.
So a lot of times when we're talking about deficits, we are talking about negative and we're seeing increases. What then, if we were to see positive news about deficits, cutting them back, how would that
Yeah.
be impact? Would it be exactly the reverse?
Yeah, it's a really good question. I do indeed find this like symmetric response. So news of higher future expected deficits leads to this increase in rates. News of lower future expected deficits leads to a decrease in rates. This is actually, I think, really a good question because we do see this increase in deficits over time. But what I find is really important is what you expected. So
Right.
if you expected, higher rates and then they actually or higher deficits and then you get a negative shock, so you then have a revision of your expectations to lower expected deficit rates, that this would lead to a negative response in yields. And so having a measure that allows for both positive and negative, I find is really important.
What do you think then should be the response or I guess more so the impact on fiscal policy and how they think about it and how it's put forward when you see research like this and these shocks that obviously come into play?
Yeah, so I think that it's really a question of like how the decisions today can impact you going forward. And so we see, for instance, with these shocks coming from the budget resolution reconciliation process, I think one of the reasons why they get so much attention is because they do have these long-term impacts.
Right.
Because, for instance, let's say one example is like the Tax Cuts and Jobs Act of 2017. So there are these tax cuts that were legislated for 10 years. So that's why you often hear like, oh, these tax cuts are expiring. What is Congress going to do next? So we find that there are these effects on financial markets, but also it's likely that it's constraining potentially what Congress can do going forward since this legislation is so impactful.
You also mentioned in the paper that there are instances where a fiscal shock can have an impact on monetary policy as well. So there is a crossover.
Yeah, so there is indeed like this kind of like interaction between fiscal and monetary policy. That was actually one of what the first questions I had, one of the original like motivations for studying this. And so I find that when the Fed is constrained at the zero lower bound, um, then the effects of these deficit news shocks are much more attenuated. So essentially, when Congress can't decrease rates any further and they're unlikely to increase rates in response to news of higher deficits when they're at the zero lower bound because they're trying to stimulate the economy. So when they get news of higher future deficits, kind of in the direction of the policy they would like, that the response in bond markets is much more attenuated,
Right.
and this actually leads to a significant increase in equity markets. And so, to the extent that there's this kind of like coordination between fiscal and monetary policy, I find that they're separate institutions with their own mandates and incentives, but it also depends on the like overall environment. So we see like even let's say in the 90s or 80s, Chair Greenspan talking about in a testimony to Congress about how, well, what the FOMC is going to do is going to depend on what Congress does with its budget resolution. So there
Right.
can be some coordination.
Right. And so there is that correlation between how the Fed reacts to what we see go on in fiscal policy. Maybe we don't
Mhm.
correlate it as much as we probably should, though, right?
Right. And I think it too it can depend on the overall like economic environment as well.
Yeah.
So like you can think about really large like, negative economic shock like COVID. You think, okay, the Fed's going to lower rates and Congress is going to try to stimulate the economy. So those that could be an example of where there's like kind of predictable like correlation between the directions of these policies. And that's why I think it's really crucial too to like have a shock measure that exists outside of these big like negative economic shocks as well, because both policies are always happening, even outside of recessions. And that's why I think that this fiscal policy measure can be unpredictable because it's always happening, and Congress is very difficult to predict.
What do you hope is the big takeaway from doing this research? And on top of that, is there a next logical step where you would like to take this research into the next level?
It's a good question. Yeah, I think of some goals I have with the paper is just to improve our understanding of how Congress, makes its fiscal policy, and also to then understand. Okay, what are the effects on financial markets from that? And I think that's why that's really important, and why I'm interested in digging into that further is because what Congress does, the legislation it passes has a direct determinant on the overall deficit level. And then the overall deficit level has a direct impact on the overall treasury supply. And treasury supply is like the largest bond market in the world and the safe haven, and often uses like the risk free rate in our model. So, to the extent that Congress affects this very large and important financial market, I think that that's really important and something I'm interested in like pushing on further as well.
Courtney, great to talk with you. Thanks very much for your time and look forward to chatting again down the road.
Thank you. Great talking to you as well.
Thank you. Courtney Wiegand, who is an assistant professor of finance here at the Wharton School.